Hello everyone! Well done for the progress you've made with the module so far. We've nearly reached the end of the term, and this week we will focus on some of the last concepts which you need to learn in this module. This week we'll start studying the basics of corporate finance, and in this video lecture we'll focus on the sources of business finance. By the end of the week, hopefully you should be able to identify the meaning and purpose of both short-term and long-term finance, identify various sources of finance for companies, and understand the factors which determine firms' financial requirements. You should also be able to understand the concepts of shares, bonds, debentures, and some other types of financing, and be able to distinguish between different types of shares, equity shares and preference shares. Let's proceed. So first of all, let's discuss why finance is required for the companies. Finance basically refers to sources of money for the business. Businesses need money to start up their operations, for example, to pay for premises, buy equipment, run an advertising campaign. To run a business, for example, to pay for day-to-day operations like staff wages, supplies, materials, and so on. And to expand the business, for example, to open a new branch or a shop in another location, or to enter a new market or launch a new product. New businesses might find it hard to raise funds, as they usually only have a small customer base and a lot of competitors, which can make lending or investing into this venture riskier. Lenders and investors might be put off by this risk, and the company might struggle to fund its operations. Nevertheless, finance is required for all companies, and each company needs to develop its financing mix, a combination of short-term and long-term funding. So generally, the difference between short and long-term finance is the time period and purpose. Short-term finance usually refers to instruments with a maturity less than 1 year, and it's usually used to finance working capital. That's the time period, that's the purpose. Long-term finance, on the other hand, covers financial instruments which maturity longer than 1 year, frequently 10, 15, or 20 years. This is the type, and the purpose of the long-term finance is to purchase fixed assets, for example, land, buildings, production equipment, machinery. These assets can be considered the foundation of the business. They are used for a long period of time, and therefore they require long-term funding. So long-term finance is used for investing purposes. Apart from use, long-term finance is necessary to finance the permanent part of working capital. In order to function smoothly, a business needs a certain amount of working capital, which is used again and again and again. This requirement to have a certain amount of money in its disposal is of permanent nature for any company. Hence again, a firm needs to ensure that it raises long-term finance for this purpose. And apart from this, long-term finance is used to finance growth and expansion of the business. Business expansion frequently requires significant investment, which will tie in the capital for extended period of time before it starts to generate profit for the company. Therefore, each company needs to ensure that it can afford to tie in this capital for this required period of time and will not be forced to withdraw it from its investment projects prematurely in order to repay debts to creditors or make some other payments, cover some other expenditure. In other words, this finance for growth and expansion of business also needs to come from long-term sources. The need for long-term finance, in other words, how much long-term capital a firm requires and needs to raise, depends on several factors. First of all, the nature of business. Different types of businesses require different amount of fixed capital. For example, a manufacturing company, let's say a car manufacturer like Jaguar, requires land, buildings, factories, production equipment, various machines, possibly a fleet of delivery vehicles, and so on. It has to invest a large amount of capital for a long period. While a modern virtual organization, which doesn't have own production facilities and only gathers customer orders and arranges deliveries directly from suppliers, like Amazon, or a company which provides a virtual platform for other online services, might operate from someone's home office because it only needs a computer with broadband access and a phone line. In many cases, it can also automate most of its processes, and therefore it doesn't need a lot of fixed capital at all. It doesn't even need to have its own computer servers for its websites, as they can be located in external data centers which specialize in web hosting, and all servicing can be outsourced. Or another example, if your business produces washing machines, you need a large factory and a lot of invested capital. If your business sells or advertises or repairs washing machines, you won't need a lot of fixed capital at all. In other words, the nature of the business is a major factor which determines long-term financial requirements for a company. Another important factor is the nature of goods produced. Similarly, if your business deals with large and complex products like cars or oil refining equipment or aircrafts, the chances are you'll need bigger buildings and more equipment, and therefore investment into fixed capital, compared to companies which produce simple and small items like dog lids or spoons or pencils. Or if you are a marketing agency which produces digital products like logos and slogans or some other promotional products for other organizations. The nature of products you produce plays a role in your financial requirements. And the final factor which you need to be aware of is the technology used. Again, depending on how you produce your products, whether you need to use the physical heavy machinery, or you only need a bunch of computers connected to internet, or you use a labor-intensive technology, for example, you run a cleaning agency, the technology used will determine how much you need to invest into a fixed capital and therefore your long-term financial requirements. Let's have a look at the difference between short and long-term finance and the main sources for both. Short-term financing is aimed to meet the demand for current assets and pay the current liabilities of the organization. In other words, it helps in minimizing the gap between current assets and current liabilities. And there are different means to raise capital for the company for a short period of time. This can include traditional bank overdrafts, many of you will be familiar with this, or short-term bank loans. These are easy to understand sources. Trade credit can be a great source of finance. Trade credit refers to the credit extended by the supplier of goods or services to his or her customer in the normal course of business. Usually it occupies a very important position in short-term financing. In many developed countries, it represents between 25 and 50% of the total short-term sources for financing working capital requirements. Almost all traders and manufacturers nowadays are expected to provide certain credit facility to their customers, without which there wouldn't be any business. They wouldn't be able to sell lots of their products. Another source of finance is factoring accounts receivable. When you will do some accounting modules further in your studies, you will study this in more detail. Generally, factoring of account receivables means selling of invoices to a third party called a factor, usually a factoring company or a bank. In other words, someone owes you money but doesn't pay. You can sell this account to another organization and they will chase this debt for you for a fraction of the cost, for a certain small fee. Another source of short-term finance for the company is accrued expenses. Accrued expenses are those which the company has incurred already, but they are not due yet, and the company hasn't paid them yet. Accruals represent a liability that the firm has to pay for the services or goods which it has received, but it delays the payment. For example, salaries and wages, interest and taxes are the major types of accruals. The longer the time lag in payments of these expenses, the longer you can delay paying this, the greater the amount of funds which the company can use in its everyday operations. Great thing about these accrued expenses is that it's interest-free source of financing, as long as you manage to delay paying this expenditure for as long as possible. Another source of short-term funding for companies is public deposits. These are simply unsecured deposits from the general public or advances which the company receives from its customers. For example, when you start living on your own, you will need to open an account with an energy company who will supply gas and electricity to the property which you rent. And majority of companies will ask you to pay for your gas and electricity in advance, for a month or two in advance. And the money will sit in your account. And the company will use these funds to finance their operations. Apart from this, a company can issue commercial paper, which represents a short-term unsecured promissory note issued by firms which have a fairly high credit rating. Usually the maturity period is between 2 weeks and a year. It's sold at a discount and is redeemed as its face value. In other words, the company does pay some interest on this source of financing. These are the short-term source of capital for period less than 1 year. However, there are situations when the company needs to attract funding for significantly longer term, for more than 1 year, and sometimes for longer than 10 years. And there are various sources which the company can use here. And majority of the long-term funding will come from the share capital or equity capital. Company can also issue preference shares, debentures and bonds. It can also attract some long-term loans from banks and other financial institutions. It can attract venture funding from venture capitalists and business angels. And of course, it can also use its own retained earnings. Let's discuss these sources of the long-term finance in more detail in the next video.